All right, listen up, my little money monkeys. Picture this. You're sitting in the jungle like our friend Money Monkey, wooden desk, laptop open, a few bananas on the side, and a big question on your mind. What is actually the better investment, real estate or the stock market? Because if you're around 40, maybe a little older, you've probably heard both stories. One guy says real estate made him rich. Another guy says stocks made him rich. And somewhere in between, you're sitting there thinking, okay, but what should I actually do? And that's exactly what we're going to talk about today. Because the truth is, most beginners make this decision completely wrong. They chase what sounds exciting. They chase what worked for someone else. But Money Monkey does things differently. Money Monkey follows logic, data, and patience, not hype. So today we're going to break down both worlds, real estate and the stock market. And by the end of this video, you'll understand which one might actually fit your life. Let's start with a very simple question. Why do people invest in the first place? It's not just about making money. It's about making your money work while you sleep. Because if your money is sitting in a bank account doing nothing, inflation is slowly eating it like termites eating a wooden jungle hut. Every year, your money becomes a little weaker. And that's why investing exists. Now, when most beginners start looking into investing, two big options appear: real estate and stocks. Let's talk about real estate first. Real estate is attractive for one big reason. You can control the asset. If you own a rental property, you decide the rent. You decide how the property is managed. You decide whether you renovate it, refinance it, or sell it. Money Monkey likes control. But real estate also requires something many people underestimate: work, tenants, repairs, maintenance, and sometimes toilets that break at 3 in the morning. Money Monkey does not like broken toilets. Now here's how investors usually measure real estate performance. It's called cash-on-cash return. Sounds complicated, but it's actually simple. Imagine you buy a property for $1 million. You don't pay the whole thing. You put down $100,000 as a down payment. The bank finances the remaining $900,000. Now let's say the property generates rental income. After paying the mortgage, insurance, taxes, and maintenance, you are left with $10,000 per year in profit. Your initial investment was $100,000. So your annual return is $10,000 divided by $100,000. That's a 10% cash-on-cash return. In real estate investing, many investors aim for something roughly between 8% and 12%. If the return is significantly lower, many investors simply choose a different investment. Now here's where things get interesting. Real estate has 3 main ways to make money. Number 1, rental income, the money tenants pay every month. Number 2, property appreciation. Over long periods of time, real estate values often increase. Not every year, not everywhere. But historically, property tends to rise with population growth and inflation. And number 3, tax advantages like depreciation in certain tax systems. Now compare that with the stock market. The stock market works differently. Instead of owning buildings, you own pieces of companies. Companies like Apple, Microsoft, or thousands of businesses at once through something called an ETF. Money Monkey loves ETFs. Because ETFs allow you to invest in hundreds or even thousands of companies with a single purchase. One of the most famous examples is an ETF that tracks the S&P 500. The S&P 500 represents roughly 500 of the largest companies in the United States. Historically, and this is important, the long-term average annual return of the S&P 500 has been roughly around 8 to 10% per year over many decades. Some years the market falls. Some years it rises strongly. But long-term, it has historically grown. Now, here is the big difference between stocks and real estate. Stocks are extremely passive. Money Monkey opens his laptop, clicks a few buttons, buys an ETF, And that's it. No tenants, no repairs, no broken jungle plumbing, just ownership of businesses around the world. With stock market investing, you typically earn money in two ways. First, price appreciation. If the companies grow and become more profitable, the value of your investment grows. Second, dividends. Some companies distribute part of their profits to shareholders. These payments can be reinvested to buy more shares. And that's where something powerful happens. Compound growth. Let's make a simple example. Imagine you invest $500 per month into an ETF. Not a huge amount. Many people spend more than that on random subscriptions, gadgets, and things they forget about 2 weeks later. Now assume a long-term average return of 8% per year. After 10 years, you would have invested $60,000. But your portfolio could be worth around $90,000. After 20 years, you would have invested $120,000. Your portfolio might grow to roughly $300,000. And after 30 years, the numbers become really interesting. You would have invested $180,000. But your portfolio could grow to around $700,000 or more, depending on market returns. Not because you're a genius, not because you trade every day, but because you stayed invested and let time do the heavy lifting. Money Monkey calls this the banana tree strategy. You plant the tree, you water it, and then you stop digging it up every 2 weeks to check if it's growing. Most beginners fail because they do exactly that. They panic when markets drop. They chase trending stocks. They jump in and out of investments. That behavior destroys long-term returns. Real wealth building is boring. Consistent investing. Long time horizons. Patience. Now here's something important. Real estate can absolutely build wealth. Many successful investors built large fortunes through property. But real estate usually requires higher starting capital, financing approval, ongoing management, and sometimes significant risk in a single property or location. Stock market investing, especially through diversified ETFs, spreads your risk across hundreds of companies instantly. That's why many long-term investors combine both strategies: real estate for leverage and tangible assets, stocks and ETFs for passive growth and diversification. Money Monkey personally loves the simplicity of ETFs because investing should not feel like running a second full-time job. It should feel like planting seeds for the future. Now, if you're a beginner watching this, here is the practical approach Money Monkey would suggest. Start simple. Open a brokerage account. Choose 1 or 2 broad market ETFs. Invest consistently every month. $50, $100, $200. Whatever fits your budget. Increase contributions as your income grows. Ignore short-term market noise. Think in decades, not weeks. And if one day you decide to add real estate to your portfolio, great. But don't wait 10 years trying to buy the perfect property while your money sits idle. Start investing somewhere, because time in the market is usually more powerful than timing the market. Your future self will thank you for starting today. And remember something important. Wealth is rarely built through one lucky decision. It's built through hundreds of small, boring, disciplined decisions. Invest regularly. Stay patient. Avoid hype. And let compound growth work for you. Even Money Monkey understands that. And if a monkey in a jungle with a laptop can understand investing, you definitely can too. This is Money Monkey. Keep learning. Keep investing. And I'll see you in the next video. Monkey Money Bag.